Hello everyone and welcome back to another episode. I'm always so excited every single month doing these for looking over my M1 Finance portfolio. These are always my favorite. These are the best because I get to give these monthly updates, which is right here. My month over month update on my portfolio balance, and for 9/1 September 1st of 2022, my balance was $38,888. This is what the chart looked like before. And this is what it looks like now. This is what it was as of the close of September 1st, which was last Thursday. And so we are doing really good. That is a new all-time high, and we're edging up towards $40,000. Maybe in October we'll be breaking $40,000, but regardless, either way, I'm super excited about that. Thank you for tuning in. We're going to show the updates for my portfolio, any big changes I've made, and also talk about where I think things are going forward in terms of the market, in terms of my portfolio, and how my performance was. Now, this shows where I'm at today. Now, this is September 6th as of the time of filming this, so this has moved a couple $100 from the time I filmed out this portfolio update. And then, of course, this is my performance. My 1 month return did beat the market by a significant amount. All 4 indexes, the Russell 2000, NASDAQ, Dow Jones, and S&P, were all negative about 2 to 4%, and then my portfolio was plus 14%. The last 3 months were beating a dramatic, insane amount, all of them flat to slightly negative. I'm up 50%. Year to date, we are now beating all 4 by a tiny slim margin of about 2 to 14%, depending on what we're looking at. And then looking at the 1 year, we're about matching or even slightly behind. This is my month over month return since joining Fidelity, and you can see that my portfolio goes back a lot further than that. When I started my YouTube channel, it goes back to April of 2020, going back to that small $1,500, which is just crazy to think about now. We're edging up towards $40,000. But anyways, guys, you came here for the M1 Finance dividend portfolio, so that's what we're going to do. We're going to break that down and go over it, and we're also going to look at the 2 holdings in the growth portfolio. But if you haven't seen me before, my name is Jordan. I'm a millennial investor, and what I do is I disclose my investments every single day, every single week, every single month. So that way you guys can get a real look of what it's like to own a growth portfolio and a dividend growth portfolio. Now, I have lots of opportunities down below, including mentoring calls, Yada savings accounts, credit card referrals, all types of stuff like that. And we've had 125 people sign up so far. So if you like this platform, if you like M1 Finance and you want to use it, you want to sign up for it, you can get $10 for doing so. 125 people have done so far, and you guys have helped me and helped support the channel by signing up for that, so check it out if you haven't already. But without further ado, let's go ahead and get started. The 2 stocks in the growth portfolio I won't really go over too much. Amazon and Salesforce, very simple. Amazon, I mostly have the investment thesis behind AWS and their growing e-commerce business, but it's extremely simple. The company's at an all-time low pretty much for the last several years. And then looking at Salesforce, you have a business that continually grows, like I have pulled up right here. Look at the quarter-over-quarter growth. Record after record numbers. If you look at the profitability, it's free cash flow, record after record, and it's expected to continue. Despite that, the company's stock price, as you can see, is down 42% in the last year. The stock price goes down, but the business is doing great, and that's what I want to see as an investor, because that's what creates opportunities. Now let's go ahead and take a look at the dividend growth portfolio, because this is what you guys are here for. If you didn't know, in the last month, I moved a little things around, a couple things up, a little percent here, a little percent there, but JP Morgan is now the largest holding in the portfolio. Why is that? Why is that the largest holding in the portfolio, and why did I move it up this month? Because I think that this is the perfect opportunity for, as a defensive investor that is a dividend growth investor, in my opinion, I think that it is an attractive buy at these prices. Now, let's go back here. Let's look at these 2 portfolios. What is the reason why you should own one or the other? The reason why the growth portfolio is attractive is if you're young, if you're aggressive with your money, you only want to own a couple holdings so you can really get concentrated in your capital, and you will have wildly volatile returns. When times are bad, you'll lose a lot. When times are good, you'll make a lot. With the dividend growth portfolio is a naturally conservative investment strategy, diversified between 21 different companies in all different types of industry, all different business models, yields, valuations, all that type of stuff. JP Morgan is one of the best defensive defensive investments that I think that there is in the market. The company has over a 3.5% dividend yield. The stock prices went nowhere, if not down, over the last 5 years. It's up 24% in the last 5 years. That's like nothing, guys. It pays a steady dividend. They're extremely profitable. I mean, I don't think I need to explain how profitable JP Morgan is. If it's the largest bank in the world, I think it becomes pretty apparent how profitable this company is. Over $1 trillion on hand that the company has, with a T, just outstanding. Last year's net income was $48 billion with a B, and it is just ridiculous, guys, to think that the highest quality bank in the world, in my opinion, is trading at this valuation. It's very rare that you see JP Morgan trade at this type of valuation, but it is right now, and so that's why I made it the largest position. I don't expect to have it this way for 5 years, or probably not even 2 or 3 years, but I think that right now having it at the large position in the portfolio is a smart move with the way the economy and interest rates are moving. Now, WP Carey, I've made many videos about, I've talked about so many times, but I think it's my favorite REIT, real estate investment trust in the market. Great dividend yield, awesome defensiveness, has incredible rent escalation opportunities for when CPI is running hot like it is today. So as CPI runs high, it benefits companies like WP Carey because they already own properties that they can raise the rents on every year, 3%, 5%, whatever the case may be, and all they have to do is just sit back and own it. These are very lean business models. It doesn't take a lot of money to run a company like a WP Carey or a Realty Income, because if you look at their expenses and you take away all this and you look at R&D, research and development, how much is here? Zero. There's nothing, because it doesn't need anything to run the business. It's very easy. They just buy properties, rent them out, and then bring in the profits and distribute 90% of the profits back to shareholders. Lockheed Martin, a great potential opportunity with geopolitical tensions going on between Russia, China, Taiwan, any other countries that want to get involved. Who knows, probably 10 more will join by the end of the year, because that's the way things are going. But regardless, whether or not there will be any sort of World War III or not, what will happen is this company will continue to make massive profits over time as people continue to spend on the military, specifically the United States. This company is basically providing all the things we need for the Air Force. Look at the annual charts for this. It continually goes up. Look at the free cash flow. Continually goes up. Do you think that we're going to stop spending money on the military? Because if you do, I disagree. I don't think we will. If that's the case, then this company will continue to be profitable. They have billions upon billions of dollars in the backlog, and I think the company trades at a decent valuation with a great dividend yield. It's that why Lockheed Martin's one of the top ones. Visa, one of the best, most efficient business models you will find. Visa, if we look at this and we pull up one statistic here that I think is most important. If we take away all these, so let's look at the top 4 that we have here on Qualterm Insights, which is the return on capital employed, gross margin, operating margin, and profit margin. The most important of all of these, in my opinion, is profit margin. What does Visa actually bring in for every dollar of revenue they get? So if you don't know, pretend you have a profit margin of 10. If you sell something for $100 and your profit margin 10%, then your profit is $10. Got it? So say if your profit margin was 50%, then for every $100 you bring in, $50 is what you actually keep in your pocket as the business. Now, what is Visa's? Right around what I said. As of last year, it was 51%. If we go to the most recent quarter, it has gone down a little bit, but still, even with it going down, it is still at 47%. Typically, this company has a profit margin of the low to mid 50s, which is just insane. Even if you compare that to some of the most best business models on the planet, which are very efficient, like a Microsoft, it has fantastic profitability. And if you look at its profit margins are typically in the low to mid 30s. And Visa's in the low to mid 50s, so like almost double that. It is not even close. It's a very efficient business model, lots of growth, continues to grow their revenues. I can't click my mouse. I keep on switching to the wrong tab. Visa continues to grow its revenues, even looking at the most recent quarter, putting up a record $7.28 billion, and it has a crappy dividend yield of starting only 0.8%. But nonetheless, guys, I think there's lots of room for opportunity for growth of the business and the dividend, and they typically raise that dividend anywhere 10, 15, 20% a year. So there's lots of opportunity there. Realty Income, pretty much the same as WP Carey, real estate investment trust that pays out every single month, raises the dividend at least 4 times a year. You heard me right, not once a year, a minimum of of 4 times a year, and the dividend yield is nice at 4+%, and is one of the best quality real estate investment trusts in the market. There's really only a couple REITs in the entire stock market, in my opinion, that I'm actually interested in investing in, and these are 2 of them. And there's one more we're about to go over in just a moment. Broadcom, a company that's a great semiconductor chip. I think, I sit and I think about where the country and where the globe is moving forward with semiconductor, and sometimes these microchip companies are a little bit hard to predict. They're one of the things I don't like about them, but that said, nonetheless, we're going to need them. Now, we could discuss whether or not shortages will continue, whether this company continue to innovate and raise its prices, but nonetheless, this company continues to be in high demand of its products, and it's also diversifying as well into the software business. They just bought out VMware, or they're in the process of buying it out, I should say, but this company's continually grown its business, like you'll see with all these, dramatically. Look at this. Just say, let's go 10 years ago, okay? It's 2022. What were they doing a quarter in, let's see, late 2012? They were doing about $0.6 billion every single quarter. What are they doing today? $8.46 billion. That's like a 15x in revenue in 10 years. That is just ridiculous. And if you look at the free cash flow, if you look at the profitability, it's the same story, which is why this company's dividend has also done the same thing. 2012, 15-cent dividend. Now it's $4.10. That is just a ridiculous move up. What is that, like a 30x almost in dividend in just 10 years? So this company continues to innovate, continues to produce massive profits, and I don't think that's going to stop anytime soon. So Broadcom is a good one, continually stays pretty low valuation with pretty high dividend yields, not to mention usually in November, which is not too far away, they normally raise that dividend pretty hefty at the end of the year, so stay tuned for that. Now, next up after Broadcom, we have another one of my favorites, which is the one we were talking about in terms of real estate investment trusts. There's really only maybe 4 or 5 names in the entire market that are real estate investment trusts that I find attractive, and these are the 3 that we own in the portfolio. Now, they did raise their dividend last year at almost 10%, and they're due to raise that dividend coming up on their next payment, which should be very soon. So if they decide to raise it, we'll probably find out within the next week or 2. So I'll stay tuned, give you an update there. But basically, essentially what this is this owns the Vegas Strip. If you know any of the big casinos, any of the big gaming industries that go along with Vegas, this company probably owns it. And if you were wondering, in case you were thinking, is the Vegas Strip profitable? I'll let you decide. If you think the answer is yes, then this is probably a decent company to own, because Vici, like I said, practically owns the entire strip, massively profitable, pays out lots of dividends, is one of the great real estate investment trusts. Like I said, there's not many I like, and these are the 3 that I like. Pepsi, I've always talked so many times every single month how I have a bias. I love Mountain Dew. I love Cheetos. I love Doritos. I love all different types of products that this company produces, and the brands beyond Pepsi is just ridiculous. I was curious, I was about to go on about the brands that they own, but I'll just give you an idea. And there's more that's not even included on this list, but just look at some of the big names in this on both beverages and food categories. From Pepsi to Mountain Dew to Doritos to Lay's to Cap'n Crunch to Ruffles, Tostitos, Lipton Sweet Tea, Aquafina. They do packaging for Starbucks products, Quaker Oats, Chewy, Life Water, Tropicana. It just goes on and on and on. I'm sure you know almost every single one of these brands, if not every single one. And that's what causes, like always, if you keep on noticing a trend here, I pick companies that grow in revenue and profits. All-time revenue records, pretty much all-time profit records, other than that one little hiccup here. You get the point. The company has continued to increase its dividend massively year after year after year, and basically, the only way that this company could ever go bankrupt is if every single one of these brands that you see here stop existing. Every single person would have to stop eating and stop drinking every single one of these brands, and this is a really boring, non-volatile company. It's an easy money stock. If you buy it and hold it for 10 years, the odds of you making money are pretty high. It's not financial advice. Do your own research. But what are the odds that Pepsi goes under? Pretty dang low. Now, consumer trends may shift. People might stop liking Pepsi products as much as they do today. Who knows? But they continually innovate. They pay attention to trends. And with such a massive, dominant market share at almost $250 billion in market cap, I don't ever see a scenario where Pepsi goes away in the next 100 years? I mean, maybe ever. I mean, honestly, the odds are that this company will outlive me and my kids and my grandchildren and maybe even the kids before them. Assuming the world, the United States is still in existence, the odds are Pepsi's going to be around. Home Depot is one of the most efficient retailers that people tend to ignore. The company has finally started to come down in share price from previously hitting highs of around 415 and now being down below 300. The company's finally starting to get an attractive valuation and attractive dividend yield. The company, as we keep on seeing with many of these companies, runs a very efficient business model, has lots of good metrics such as its return on capital employed being very high, last year producing 53% metric in terms of that, while having continually high growing margins in terms of its gross margins, operating margins, and most importantly, in my opinion, which is profit margins. You see that not only is the business growing, but it's becoming more efficient. You likely wouldn't think that with a boring brick and mortar store like Home Depot, but I don't think of them as just a brick and mortar store. I think of them as a specialty retailer. And the reason is because they're one of the few businesses that I don't really think can be disrupted by Amazon. Let's look at Amazon. If you take a look at Amazon, that that annual revenue chart is just astounding. They continue to dominate the e-commerce market. But why, if this e-commerce business is growing so nice, is a company like Home Depot continually hitting record numbers? If you look at a company like, say, I don't know, let's look at Dollar Tree. I'm just coming up with something off the spot. I actually used to work for that company for a while. Why is it not pulling up? DLTR, I think is the ticker. Yeah, there we go. Dollar Tree. This company has grown its revenue, but if you look over the last couple of years, it started to stagnate. It's getting decent, but the company's profitability has started to falter. It's kind of flattened out in the last couple of years. Looking at its free cash flow, if anything, it's actually kind of trended downward since about 2017, other than the one hiccup year in 2021. Now, if you look at Home Depot, it has done the exact opposite. While it's grown revenue, it has done the better part of things, which is grow profitability. If you look at that net income coming in at an astounding $16 billion last year, it is hitting all-time records. It's a specialty retail in the sense that people like to shop for things like appliances, home improvements. They like to shop for those in person. You're not really going to buy, let's say if you wanted to remodel your entire bathroom and you wanted to buy a $5,000 shower, okay? Are you going to shop on that at Amazon? Probably not. You want to see it in person. You want to physically touch it, see what it looks like, model it out. You're not going to shop for that on Amazon. That's not really something that's logistically easy for Amazon to manufacture and ship anyway and install. Not saying they can't do it, but it's not very easy, and that's what gives something like Home Depot an advantage. They already have a massive footprint across the country and as well as the globe, and so I think they're going to be around for a long time and continue to be profitable. Boring company, Kimberly-Clark. In the same way that we talked about Pepsi being dominant in brands for food and drink, this is the brand around paper products. Paper towels, toilet paper, feminine care products, you name it. They sell it and they produce it and they make money off of it. Very simple, very boring. Stable dividend yield, stable company, doesn't move around a lot, and it's very easy to collect dividends off of. I just made a video about this, so I won't go over 3M. If you want to check out my little brief overview of 3M, you can watch that. I just posted it a couple days ago, I think 3 days before this. But this company has had a really tough time. Down 40% in the last 5 years, despite the market doing pretty well over the last 5 years. This company has a massive 5% dividend yield, and they're a massive conglomerate that grows alongside the economy. Like I said, if you want to see more information, watch my video I just made on it. Whirlpool, very simple, something that benefits from something like a Home Depot, makes very simple standard products. Home appliances like dishwashers, like washers, like dryers, like air purifiers, and lots of other simple things like that, but they do it and they do it well. They also own many other brands, like Maytag. This company continues to just dominate, pretty much has a monopoly on household appliances, and you don't even think about it. This is something where you only have to buy so often, but when you do buy, they're going to buy it at a massive profit margin for Whirlpool. And they have such a dominant position and such brand recognition behind their names that they continue to produce massive profits, and they are a slow grower and they're a boring company. Like many of the companies on this list, they're extremely boring. They're not well thought out. You don't have to have some complex, crazy investing strategy of this company's going to change the world, some rapid movement has to happen. Sometimes it's as simple as selling appliances. Sometimes it's as simple as selling toilet paper or specialty products or a bag of chips or owning real estate. It's not always have to be something crazy or sexy appeal. It can sometimes be just as easy as that. And it goes hand in hand with many of these companies, including this one, Altria. Tobacco products, whether you're talking about it steak and jewel or some of it's, it's cannabis products, we won't get too deep into that because YouTube doesn't want to demonetize us, but it pretty much, if you buy tobacco, you probably get profits in the pockets of Altria shareholders because this company continues to raise its dividend, it continues to grow, but despite it growing, if we look at its all-time revenue chart, it continues to grow for one reason, unfortunately. If you ignore here from 2007, that's when they did the split. If you look here from 2008, went from 15 billion, and now in most recent years, it's 21 billion. This becomes more apparent when you look at the quarterly chart. You can see it's a little bit better. It's slowly growing. But if you look at its earnings per share, especially on an annual basis, if you look at its earnings per share, it's finally started to grow until recently. Why is that? Why has this company started to falter? Because people don't like to smoke as much as they used to. People that buy cigarettes that are the prime smokers are unfortunately the older generation, and what is happening to the older generation, they're dying out and being replaced by the newer, younger people. Newer, younger people, statistically, are much less likely to buy a cigarette than they are to buy some sort of vape product, some sort of nicotine pouch, or any other things that substitutes a cigarette. And so that said, Altria has faltered. Now this company is not a sexy company. It's not revolutionary. It's very boring. What is the one reason why I continue to own this company? The great dividend growth, its massive profit margins, and more importantly, that 8+% dividend yield. If the company stays in stock price flat every single year, I'll make about 8% every single year that I own this company. And I don't think that they're going to be some massive grower. And I think one day, decades from now, they probably will have to change their business or die out. But a free 8% per year, I can't talk, y'all. A free 8% every single year is not bad. Speaking of companies that continually pay out dividends, this is like all of them. Target is a company that has done very well until the last year or so, like many of these stocks. If you look over the last 5 years, if you go to the peak of 2021, this company on the 5-year chart was up 366%. And now it's down to under 200% gains over the last 5 years. This company hit major headwinds when it had its earnings report in about, let's say, May or so. It had big inventory problems, much like its direct competitor Walmart. And this company's in a position now where investors are not as confident on Target's futures as they once were. Now, if you were buying the stock at 250, 260, 270 a share, I think you're paying a little too much. But today, if you're buying it at 150, 160, that's $100 a share cheaper, which means a higher dividend yield, better valuations, and more opportunity for growth, and you have a higher net margin of safety. The company continues to grow, and I think people are going to continue to shop at Target. People in my age demographic love Target. I mean, my wife loves it. She loves to shop there. And if you look, right now the profits are down and out. From originally hitting about $1 billion of profit every quarter, the most recent quarter was 0.18 billion. Teeny tiny profits, and the margins have just fell through the floor. Cash flow is starting to come in negative. And now is when people are scared. Now is the time to buy when people are running for the exits and the margins and the profitability has gone down and people think they're never going to come back. My opinion is that they will come back, and that's why I'm buying the stock now. Now going next, we have Verizon. Very simple, very stable business. We're starting to get to some of the smaller holdings where I'll go over a little quicker, but very simple business model. They're a telecom company. You buy a cell phone plan, you pay it off every month, and this company makes profits doing so. Incredibly high dividend yield, one I thought I would never see this high, but you know what? It's not a business I like all that much, but with a dividend yield so high and a business that is very consistent, I don't like that it doesn't innovate and it's very old with a lot of debt, but it's a high dividend yield. It continues to grow, and I think they'll have a stable business. Starbucks is one that I've started to chip away at a little bit here and there. They are facing some issues with China, but basically I think people's addiction to, coffee products, especially with things like caffeine. I mean, if there's anybody that's shown that, it's Pepsi. People like caffeine. I am no exception. If that's the case, people will continue to be addicted to caffeine and coffee as well. They're due for another dividend raise soon, so stay tuned to that. Might give an update to that. But the company consistently has a decent dividend yield, a decent valuation, and I think that people are starting to consider the paying overheating coming in from China, and that's why the stock has really sold off since around the turn of the year, since about January 1st of this year. And about the beginning of the year, it was about $120 stock, $115 stock. Today, you can buy it for $85. So now is the time where I think it's better to be buying than it was 6 months or a year ago. Now, looking at Procter & Gamble, I just made a video about this as well, so go ahead and watch that. I won't break it down. Very simple, very boring company. If you walk in something like Walmart, Target, I mean, they're pretty much on every single aisle selling you half the products in the store. So if you looked at it, I know you might not know this company's brand, but I promise you, you know the umbrella of brands, the hundreds of companies under it. The only energy company in the portfolio, NextEra Energy Partners, basically just a simple diversification play betting on renewables that continually raises the dividend every single quarter, currently having a 3.5% dividend yield. Caterpillar, very simple company, has a long track record of surviving even the worst of recessions. Typically, people tend to overshoot the dramatic downturn in revenue that is supposedly supposed to come for a company like revenue in recessions. And it is true, they are cyclical, but I think this company's going to be fine. They have a decent dividend yield. It's a very small weighting in the portfolio of 2%. And speaking of small weightings, we get to the two 1%ers, which is McDonald's and Coca-Cola. I love these companies. They're very stable, but the valuations are a bit high. The dividend yields are a bit low, and they are core holdings that I don't ever plan to sell, but I just want to lower my target percentage. While they haven't really been hit hard throughout the recession, I think it's better to focus on companies like, say, something like, I don't know, a JP Morgan, for example, that has went massively down, has much better valuation than invest in something that's topping out in the market like a McDonald's or Coca-Cola. But that's every stock in the portfolio, guys. We did very well. We had 38,888 through September 1st. My net worth, this isn't even my net worth. This is just my well, actually, it's not even my liquid net worth. I even have savings beyond that, but my net worth is growing at a massive level. My portfolio value is growing at a massive level. And it's crazy to see that if you continually contribute to your portfolio, despite the market going down, you can do very well. Like I said, going back to these performance, the year-to-date performance for all the indexes is anywhere from minus 12% to as high as minus 24% for the NASDAQ, which is what my portfolio most closely resembles in the growth portfolio. Despite that, we're still hitting all-time highs. So that's encouraging, that's motivating. Hopefully we'll hit 40,000 in 2022, hopefully 50,000 in 2023. But regardless, guys, I'll continually showing my portfolio and hopefully entertaining you as you continue to watch my channel. I would hope that you would subscribe if you watch all the way to the end. This portfolio is shared down in the description if you want to invest in it yourself, modify it, tweak it, or just take a look at it. It's all down below in the description. So feel free to take advantage of that as well as everything down below in the description. Get your free $10 within one finance, like the 125 people that have done so far. Thank you guys so much for watching. I'm Jordan. I'm Millennial Investor, and I'll catch you guys next time.